Good morning and welcome to CMC Markets on Friday the 29th of November and this quick look at the week ahead beginning the 2nd of December. It's been a fairly sideways trading past 3 weeks. European markets haven't really gone anywhere. Yes, we've made marginal new multi-month highs, but overall the gains that we've seen in European markets have continued to lag behind US markets, which have continued to make new record highs on the Dow, the S&P and the Nasdaq. That being said, despite the fact that we're likely to trade in a fairly neutral fashion or finish in a fairly neutral fashion for this week, we're still on course to close higher. European markets are still on course to close higher for the third successive month in a row. And this is despite continued ongoing concerns as to whether or not we're going to get any sort of US-China phase one trade deal. And we have seen a little bit of weakness, equity market weakness at the back end of this week. Obviously the US is pretty much wound down for Thanksgiving, so trading volumes are slightly lower than they would normally be, but nonetheless there is no sign at the moment that investors are in any way nervous about the prospect that we won't see some form of consensus arrived at when it comes to trade over the course of the next few weeks. That being said, there is a little bit of concern about China-US relations in the wake of the decision on Wednesday night by President Trump to sign a bill supporting the Hong Kong protesters on Wednesday evening, and that has prompted a little bit of profit taking in Asian markets as well as European markets. And in essence, I think the signing of the bill was a warning to China that any changes to the one country, two systems could see the US strip Hong Kong of its special status. And I think what this does is it speaks to a very difficult tightrope that China and US officials have to navigate when it comes to trying to separate the trade talks and obviously the concerns about the Hong Kong uncertainty, the political uncertainty there, and any escalation in the tensions between the Hong Kong government and the demonstrators. And certainly the signing of the bill hasn't gone down particularly well with Beijing or Hong Kong government officials. Nonetheless, I think if investors were really concerned about a significant escalation in tensions, I think we'd have seen a much bigger sell-off than what we've currently seen at the moment. And if you actually look at the way European markets have behaved generally over the course of the past 3 months and contrast that to 12 months ago, where we came off the back of 3 successive monthly declines, and where markets were pretty much in freefall, finding it difficult to find buyers at any sorts of dips, the contrast is quite stark, despite the fact that the economic data that we've been seeing over the course of the past few weeks has been a little bit disappointing, but there has been some evidence of a little bit of a pickup. But certainly in terms of US markets, where US GDP came in at 2.1%, beating expectations of an unchanged 1.9%, and actually coming in better than the Q2 number, which was revised down to 2%. And against that backdrop, I think it's going to be a very important week over the course of the next few, important start to December in terms of whether or not the rebound that we've started to see in the manufacturing sector, and they are very much green shoots. The big question is, will they get snuffed out by a sharp frost? And at the moment, we won't know that for certain until potentially January or February. But certainly there is some evidence of a pickup in manufacturing activity in the last couple of months, particularly in China and the US. And even in Germany, we've actually seen a nice little pickup in manufacturing activity as well. However, there is a caveat to that, and that is that obviously services are or aren't showing any signs of finding a little bit of a base. If anything, they are going in the opposite direction. So on the 2nd of December, we've got global manufacturing PMIs We've seen German manufacturing improve, albeit from very, very low levels of the low 40s. So whether or not that's enough to suggest that the trough is in is another matter. After all, as we all know, most dead cats bounce to some extent. So at the moment, the big question is whether or not we're seeing a little bit of a dead cat bounce, or whether we're seeing a sustained improvement in the economic outlook. Services PMIs on the 4th of December, we started to see evidence of pickup in economic activity in the manufacturing sector, but that doesn't appear to be being reflected in services. Services are now starting to feel a little bit of pain. Resilience of the services sector at a time when manufacturing is picking up is a little bit worrying. Saw a 38-month low in Euro area services PMI, so that is a little bit of a worry going forward. And obviously we also have a whole host of US data out, US ISM manufacturing, US ISM non-manufacturing, US ADP payrolls report, culminating on the 6th of December with US non-farm payrolls report. And I think the low expectations around the October jobs report turned out to be a bit of a mixed blessing. I think because of the General Motors strike and what have you, there was an awful lot of pessimism already baked in when it comes to what markets were expecting in terms of the headline payrolls number. So a 128,000 number when markets were expecting something an awful lot worse than that was almost a blessing in disguise. There was concern about the fall in the wages data and a rise in the unemployment rate. The problem with that is how much of that was distorted by the General Motors strike. We could see a little bit of a rebound in the payrolls numbers for November. You've also got to price in the fact there's an awful lot of temporary hiring goes on in the lead up to Thanksgiving, and that helps boost the numbers as well. So say for example, if you look at the November payrolls numbers for previous years, we've usually seen very, very strong November and December numbers in Q4 for the US, simply because of the fact there's an awful lot of retail hiring, temporary hiring goes on, which actually helps boost the jobs numbers. So over the last few years, the last 3 months of the year has seen consistently decent job gains, and I don't see any reason as to why 2019 will be any different. So I think it's unlikely we'll see any weakness in the US labour market or in any of the US data as we head into next week, and that will impact perceptions about a Fed rate cut in December. Simply speaking, it's very unlikely to happen, and at the very least, the earliest we can expect another Fed rate cut is probably going to be March next year. So with that in mind, it's quite likely that the dollar will continue to remain strong. Certainly that's being reflected in the performance against the euro, where we've consistently seen the euro come under pressure. We can see it on this chart here. There's very, very big resistance below the 200-day moving average, but also around about 111.70. We're also now finding a bit of a barrier around about 110.90, 111 the figure. And I think if we break below this 109.80 area here that we've got from the November lows through here, then I think there's a decent chance that over the course of the next 30 days between now and Christmas, the euro will continue to fall back to the lows that we saw in at the end of September and the beginning of October. Also going to be another choppy week for the pound, given the UK election campaign is ongoing. At the moment the pound is in a little bit of a range, topped at 130 with decent support around about 126.80. Now there was a YouGov poll out earlier this week which purported to give the Conservative Party a decent chance of winning a 60 odd seat majority. Now polls are just that, they're polls, and they are going to continue to gyrate in the lead up to the 12th of December vote. So certainly I don't think it's any reason for any side to be complacent about the result on the 12th of December. And an added complication for the Conservative Party is that President Trump will be visiting for a NATO summit at the end of next week. And I think that the last thing that they will want is an intervention by a US president who is not shy of putting his size 10s firmly in his mouth. So I think there will be a few bitten fingernails amongst Conservative Party members when President Trump visits here in the early part of December. Also worth keeping an eye out is for the Bank of Canada rate decision. The economic data that we've seen out of Canada recently has actually been a little bit disappointing, and that's going to make this a very tricky decision for the Bank of Canada than it would have been 5 weeks ago. Up until then, the Canadian economy had looked quite resilient. However, recent payrolls data would appear to suggest there's a significant softening after an unexpected decline of 1.8 thousand jobs in the most recent payrolls report. Markets had been expecting a gain. Now, it is important to note that the Canadian economy does have a tendency to see surprise drops in the employment numbers, so it's important not to read too much into one set of numbers. That being said, the weakness may well prompt the Bank of Canada to be much more dovish than normal. So even if they don't cut rates when they meet later this week, they could give indications that they might be minded to do so when they next meet in January. And certainly looking at this dollar CAD chart, we can see from this line here that there is decent resistance just above 133 as the price action consolidates between 133 and 130.5. So be prepared for potentially further Canada weakness, further dollar strength up towards 134 in the event that US data surprises to the upside and any further Canada data surprises to the downside. Also keeping an eye on euro sterling in the context of obviously the UK election, and at the moment there does still appear to be evidence that the pound is continuing to gain. I think it's unlikely to take out the lows, euro sterling lows, for this year. Certainly in the next week or so, there's still all to play for when it comes to the polling and the election on the 12th of December. That being said, the line of least resistance for the moment is for euro weakness and sterling strength, but we could get a squeeze back to 86 before that happens, so we certainly need to be prepared for that. In terms of the wider things to keep an eye out for, we also have an OPEC meeting coming up this week, and we have seen oil prices start to edge higher ahead of that, coming back towards the 200-day moving average. I think it's quite likely they'll remain in a fairly steady range. It's certainly not in OPEC's interests to push them too high, but it's also not in their interests to keep them too low. And with the Aramco IPO set to launch sometime in December, very soon in the next couple of weeks, I think it's unlikely that OPEC will change its current production or output constraints that it's had in place for the past 12 to 18 months. So again, I think continued range trading in terms of crude oil prices. In terms of earnings, the one thing that I'm keeping an eye out for on the earnings front is Barclay Group, the house builder Barclay Group. So for all the concerns about a slowdown in the London and South East housing market this year, you can see from this chart here there's been pretty much one-way traffic since the lows in June for Barclay Group's share price. Certainly there doesn't appear to be any concerns on the part of investors about the outlook for this particular stock, despite the fact that in June the company reported that profits were down over 20%. Now, to mitigate this decline in profits, the company has launched 11 new developments this year, with 8 outside London in places like Winchester, Birmingham, Sevenoaks and Fleet and other commuter areas. So revenues are still solid. The company has been cautious on its 2020 guidance, so any caution there might prompt a little bit of a sell-off in the share price. Certainly you can see that in this chart here. So I think the risk is potentially towards the downside as we look ahead to Barclay Group's first half numbers, and they are due out on Friday the 6th of December. Also, in terms of the US, we've got Q3 numbers from Kroger, Q3 numbers from Tiffany. They'll be important in terms of the acquisition by LVMH of Tiffany, which has seen the share price surge sharply in the last few weeks. French company have decided to put a $16 billion ring on the US jewelry specialist, so it will be very interesting to note how much the Tiffany business has been impacted by the unrest in Hong Kong, which have acted as a drag on its business, but its US business has been underperforming as well, so it'll be interesting to see whether or not its 93 US stores have been squeezed by its cheaper rivals like Pandora. Also got numbers from Brown-Forman, Jack Daniels maker, on the 5th of December, and Slack Technologies. Now, Slack Technologies was a direct listing, one of the new IPOs / direct listings that we've had this year, and one of the many IPOs that have since underperformed. It's just about below its $26 direct listing price. Does appear to be finding a little bit of a base at the moment, just below $21, but there is decent resistance all the way through here, just below 24. So I think any sort of numbers that are better than expected could see a few stops triggered on a move through $24 a share. Otherwise, disappointment back down towards the lows that we've seen in October and the beginning of November. Okay, so that's it for what's likely to be a very, very busy first week of December. Any questions, please feel free to tweet me at mhewson_CMC. Otherwise, I wish you all a nice weekend, and good luck for trading next week.